Hello and happy Friday. Today is December 18th, 2015. I hope everybody is doing well. And in about 5 minutes, I will share with you a brief overview of what happened in the markets and the economy last month. We will talk a bit about interest rates. And lastly, I will share with you our outlook for 2016. So let's get right into it. Returns were pretty muted in the U.S. stock markets last month. The S&P 500 ended up returning only 0.3%, and it was up as of the end of November, year to date, only about 3%. There was a very much wait-and-see attitude in the markets last month. Investors were expecting a Fed interest rate increase, which we now know happened. The strong dollar continued to be a headwind for the U.S. economy, not to mention the tragic events that occurred in Paris. In economic data, we did receive a strong non-farms payroll report, growing by 271,000 jobs against expectations of 185,000, and the unemployment rate ticked down to 5%, a level that has not been seen since February 2008. The LEI, or the Conference Board's Leading Economic Indicator Index, which I talk about a lot, rose 0.6%, and the year-over-year change accelerated to 3.5%. Now, 3.5% has historically been associated with only a 10 to 15% probability of recession in the next 12 to 18 months. So that forward-looking economic indicator still looks good. As you now know, the Fed met on Wednesday and the FOMC, and they finally decided to increase short-term interest rates. They did so by 25 basis points, or 1/4%, so 0.25%. This was the first Fed funds hike in 9 years. And for the most part, the stock market and bond markets, at least on Wednesday, responded pretty positively. It has been a bit more choppy and volatile since then. But as I have said in the past, I think this move is a net positive event. It illustrates that the Fed believes that we are on solid economic footing. It also importantly means that we are in fact in mid to late stages of this economic cycle and of this economic recovery. Which brings me to our outlook for next year. Our word and our theme for 2016 is volatility. You know, for the last few years, the U.S. stock market has provided us as investors with below average volatility and yet giving us strong returns. In fact, between October of 2011 and July of 2015, as you know, the S&P 500 went almost 4 years without a correction of more than 10%. Although we do expect mid-single-digit returns for 2016, which are consistent with historical mid to late economic cycle performance, we think the path to get there is not a straight line, so buckle your seatbelts next year. This upcoming year, we especially believe that it's important for investors to work with professional financial advisors because we can help investors make rational and not emotional decisions. So to summarize, barring any unexpected shock to the economy, which is unfortunately always a possibility, we believe that 2016 will be an average year for returns. We continue to be diligent about monitoring any potential signs of economic downturn and will, of course, continue to communicate our outlook with you. As always, thank you for taking the time to watch this. I would like to wish you and your family a very happy and healthy holiday season. And if you have any questions, please feel free to give me a call. Take care.